let us recap how this incredible day played out. The Dow just had its biggest point drop in history, falling 1,190 points. That was a 4.4% drop. The Dow index has now lost 3,200 points this week alone. It is now down nearly 10% this year. The S&P, meantime, falling 4.4% as well, handing in its worst day since August of 2011. And this is the fastest correction, a 10% drop from the highs, in the entire history of the stock market. Let's focus on the big names that you know, the ones that control the market, the FANGs. They tumbled as well, and they took the market with them. You had Apple down 6.5%, Google 5.5%, and look at Microsoft, a 7% drop. Wow. So as stocks sold off, buyers, they flooded into bonds. The 10-year yield at one point traded at 1.24%, ended at 1.26%. That, by far, the lowest ever at any time in American history for that 10 years. Now, bond traders say that not only are they expecting a rate cut by the Fed on March 18th, but there is chatter, the possibility of maybe an intra-meeting cut between now and then. All told, the fear on the street is very real. So, Tim Seymour, our audience tonight is likely asking two very simple questions. What do I do now, and what comes next?
Thanks, Brian. So if you think about, first of all, when markets really start to panic, policymakers start to act. And I think that the policy response, which we've seen so many times, is certainly part of the evolution of where we go from here. The problem is we've had the conversation for 18 months about what policymakers can really do for the economy. We know what they can do short term for markets. In terms of the news flow, obviously, today we started to get both, bottom-up news flow in terms of, EPS forecasts, things cut to the bone, things that are follow through from what we've seen from companies over the last, say, 2 weeks, especially, and it's going into crescendo. You have a case here where I think the news flow, look, on the virus, let's be clear. The news flow on the virus, that trend significantly lower. And when you without getting too deep into the dynamics of the virus itself, you actually have an incubation period with the virus where my guess is we still have a lag time where that news flow should probably get worse. But maybe more importantly, in terms of the communication from officials, and this is officials around the world, that type of a response tends to come in a delayed response. So for equity players, by any definition, we are oversold. And Brian, outlined a lot of that on the way down. If you think about where we were on December 24th of 2018 for that Christmas Eve low, and you looked at the relative strength indicators for the S&P, we were at about a 12 9-day RSI relative strength, a measure of momentum. We're there now. And we're certainly, as we pointed out, put a punctuation in terms of what markets can do. The problem right now for me, Dan, and this is that markets haven't even taken out kind of where we were before the highs of the coronavirus dynamics, where we were concerned about other things.
So, it's funny. A lot of people have been talking about these mega cap stocks. We've never had the sort of concentration that we've had in the S&P 500 by so few names, and we know what they are. It's Microsoft, it's Apple, it's Google, it's Amazon. And just about a week and a half ago, they met up nearly $5 trillion of the S&P 500, and that was 17, 18% or something. So if you thought that they kind of overshot on the upside over the last few months, that the sentiment just got overly complacent relative to those, then you say to yourself, what is the level on the downside where it's gotten too oversold? And none of us know exactly what that is. And I think it's also really important to remember that this virus, it's unquantifiable, what it means to the supply chains, what it means to demand, what it means to these companies. I know there's a lot of arguments like, well, Microsoft's not really in China or this and that, whatever. That really doesn't matter. When you think about the two companies that really rattled the U.S. stock market this week, it was Apple and it was Microsoft by kind of pulling that Q1 guidance. So to me, when you think about what were the expectations for S&P earnings coming into 2020, a year after the S&P rallied 30% with no earnings growth, it was high single digits, and people felt pretty comfortable about that. Now you can throw that out the window. So the question is, do you have 2019 and 2020 with multiple expansion if the market's going to go back up with no meaningful earnings growth?
Dan's bringing up a very important point, and I think that we've talked about it for months on this show, and most people said that's not the way it goes. But, Steve, I got to ask you, coronavirus is the villain. We know that. This is the fastest 10% drop in the history of the market. I'm talking to people all day long today who are saying that they're selling ETFs. The QQQ had triplets daily average to raise collateral, to raise cash. And the ETF market makers are not there to put the bids in. How much does that crowding that Dan talked about accelerate What would be selling anyone?
It's all about positioning. It's all about leverage. But my problem is when you said what comes next. Tomorrow's Friday, ahead of the weekend news. What's the news flow that we're going to see? Is it going to be better or worse than it was today? It's going to be worse. So how do you bottom on a Friday? You don't. For me, it's 28.55. It's 100 handles lower in the S&P. That's where I find support. Then I think you can substantively bounce from there. But that's a next week story for me.
Yeah, I say for us, something important happened today. We breached the 10% drawdown. 10%, while it feels terrible, that's kind of a garden variety type pullback. And we actually put a note out this morning saying if we didn't hold at 30.50, we thought a growth scare was in play. So what's a growth scare? That's a 14 to 20% type drawdown. And we've had plenty of those since the financial crisis. We had it in 2015, 2016, fourth quarter of 2018. We had it back in 2010, 2011. So that scenario for me is now in play. What I'm watching next is 2,900. I know it's impossible to quantify what's going on right now. We've taken a stab at it, and our best guess at the moment tells us we can start to make a valuation argument again after we get down below 2,900.
But she brings up that level 30.50. Yep. That's the 200-day moving average, 30.45. So people are looking at, so when you say what's going on, people are setting their algorithms because they have no clue where this market's going. So they set them for moving averages. So you have to know the technicals for you to be
and they're going to sell
relevant.
it down to those levels. Tim, I texted you today and I said, basically, what's
going on, Tim?
Yeah, what's going on, Tim? And you said there was a technical attempt to recover today. Remember, we were only down 200,
right.
And I say only down 200 tongue in cheek before it failed. Why did we fail?
Well, to me, I think there's certainly some algo dynamics which continues to press on things. 30, 45, something in there, 200-day. It seemed it was an inevitability, not just this morning. It was an inevitability last night. We were kind of in no person's land. But, you have a case here. I want to look at where was the market really before the Fed jumped in and supplied $400 billion of balance sheet. And so just at least as a context, and this is kind of what Lori's doing, too. Get back to 28.55, which is what Steve said, which is the level on October 3 of 2019, which was that low that we hit before we essentially got the Fed to respond in the tune of QE4, which they're not saying it was. But I think you have to drop in, where was the market sentiment at that time? The market was, that was the sentiment without a world of coronavirus. That was a world where we were certainly digesting the fact that the world was struggling with the trade war dynamic, but it was struggling with what we were seeing in terms of Asian PMIs, European PMIs, and actually the leading indicators in the United States. Yeah, that is a world we at least have to get back to and address, in my view. And that's not a terrible place. That's just a place that I think takes out a lot of that Fed, even though we're going to get more Fed. But that really looks you in the eye of where we were staring at lower growth and lower earnings.
Yeah, it's not a great place to be, though, when you think about it. I've heard a lot of commentary about a sort of V reversal that's going to happen, in China once this thing moves on, given the monetary and the fiscal stimulus that people expect. But, markets can turn on a dime. Economies generally don't. And when you think about it, I think there's another theme that I keep hearing about is this deglobalization. It was kind of one of the themes of the trade war that we've been in for the last year and a half. And let me just tell you this. If you see U.S. multinationals moving out of China in a meaningful way, and there's a lot of good reasons why they should, I just think that you have to remember that China's economy has been a driving force in global growth, especially over the last decade when we've seen Europe and the U.S. kind of weak, And so if you take all that business out of there, what's going to happen to that emerging middle class that so many of our companies have been just dying to get in for? So to me, I don't think you see the global economy turn on a dime once this thing dissipates. And I'm not trying to tell a too dire of a story, but, risk asset valuations have been inflated, no doubt about it. And we saw it last Q4 or last half of last year after the Fed got in there.
I agree with you. I don't think you just see economies turn on a dime, but the S&P and markets are always forward-looking mechanisms, and they always price out 6 to 8 months, sometimes a year ahead. So you could see the market turn way before you see the economy turn, and even when we're still in the death grasp of whatever we see going on in China.
But do you think the risk of a couple percent slowdown this year, Steve, for global economies, let's call it China, let's say they're flat for the quarter, no growth, 0%. Our GDP's hit by 0.5%, Europe's hit by 1%. Does that justify?
China, when I first started in this business, when you look at this all around the table, we had double-digit growth in China. Then we went down to around 6 to 8% growth in China. And now you don't know where we are. No one believed the numbers when they were double-digit. No one believed them when they were mid-single. We don't know where their growth is.
How about this? Does one case in Brazil justify a 12% drop or whatever in their markets in a matter of days?
No, but I mean,
but no one knows where the other shoe is going to drop. No one knows where there's going to be a vaccine. I think you need a vaccine. When people are taking a stab at this when it came to tariffs and trade wars, you could sort of guesstimate. You have no way to guesstimate right now. You need a vaccine. That's it.
Well, Brazil is also, very much affected by what happens to China. When you think about also the world of commodities, the world of resources, who's the ultimate buyer of a lot of what Brazil produces? And if you think about emerging markets, and we'll have plenty of chance here in this hour to kind of get into the implications. So far, you've actually had relative stability in terms of the currencies in EM, although if you look at where they were year to date against the dollar that we spent a lot of time talking about as well, you'd seen current account deficit countries like South Africa and Brazil and some of these, off 8 to 10%. But I think back to where the market has to at least find some place where we weigh what's inevitably a policy response versus a market that was challenging the Fed to really stay out of the market. And so if you look at the long end of the curve over the last couple of days, you can see, I know it seems dramatic, and I know we've talked about the yield compression that's gone on in the United States, but on a relative basis, considering the equity moves over the last couple of days, the long end of the curve has actually not done a whole lot. We've been stuck around 125 to 135 for 2 days in the middle of an equity you-know-what storm. So I think just think about the context of global yields, what that's telling you about the world, and what's telling you about what central banks can and cannot do right now.